Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, June the 26th. I'm going to take just a brief minute to discuss what markets did last week. And wow, has so much happened in the 2 weeks since we last spoke. And before we get started, you may notice I have this cool new fancy microphone. I'd like to thank my friend, a good friend Randall, for hooking me up with that for this broadcast and moving forward. And I can now sound somewhat professional on the video chats or video recordings. So thank you very much, Randall. But back to the stocks and the stock market. Last week, the S&P 500 was the laggard for the week, and it was down only 15 basis points or 0.15%. The mid-cap index, as measured by the S&P 400, was up 61 basis points or 0.61%. And the small caps as measured by the S&P 600 were up 20 basis points or 0.2%. And wow, in the 2 weeks since we last spoke, so much has happened in the world and geopolitical headlines and things along that. And you look back at the stock market, and as we sit today on Thursday, June the 26th at about 1:17 p.m., we're right at all-time highs. And how could that be the case with everything that's going on? Well, you're going to hear kind of a theme here from me, maybe this whole year and forevermore. And the importance of that is staying invested through volatility. And so let's take a second and peel the onion back of what we have going on right now and why the market's doing what it's doing. So we have all of this geopolitical uncertainty. We had another flare up, and maybe some call it a war, whatever you want to call it, in the Middle East between Israel and Iran. But what was interesting is watching the oil market through this whole process is the oil market actually retraced and came back. The equity markets, while they had an initial reaction that first day, had you reacted with the market that first day, that 2 Fridays ago, you would have been hurting because there was a quick recovery in the equity markets. As I've said before, the average recovery day to a big drawdown is 2 to 8 days from that drawdown. So the market, again, is timing and seeing past these events and seeing the solution before that ever happens, and that's going to get priced into equity markets before a truce or a ceasefire gets delivered as the market starts sniffing it out. That's why you've seen the extreme rally that we've had in the last 2 weeks. The S&P this week is up over 2%, and it's Thursday. It's a great recovery week, and so it's important that we stay invested. So what's going on with the market? Well, we have all of this uncertainty going on with tariffs on July 9th, the deadline. We have what happened with Israel and Iran, and we have what else do we have? We have other things that are coming down the pike. Interest rates being too high and wanting interest rates to come down, and yet we're still moving forward as the stock market. Well, how can we do that? Well, let's remember, if we peel the onion back and go back several months, what was the driver? And it was really AI and the efficiency that AI could bring to corporations and companies. And we're just now starting to see the early onset of that with some of these technology companies. There are companies like Affirm, there's companies like Salesforce that say Affirm hasn't hired anyone new in 2 years. They're a fintech lending company. They haven't hired anyone new in 2 years, and AI is doing the work of what has been left. You had Mark Benioff on this morning from Salesforce saying that AI is doing 30 to 50% of the work inside of Salesforce. And so you're just now starting to see how these are going to become efficiencies that create productivity that drive corporate earnings. And remember, while there's a lot of things that drive the equity markets, at the end of the day, growth in corporate earnings are going to be what allows this market to continue to move higher. So while there are things that can impact macroeconomically the corporate earnings perspective, things really haven't changed. The underlying economy still remains resilient. There's still a lot of money on the sidelines that has not even entered in yet, even with the market at all-time highs. We are marching higher off of this AI. It's a very narrow march higher here in the last couple of weeks. But again, we're still moving higher. And it's on the backs of what the promise of AI and the promise to margin increases that it's going to do. And we're just now starting to see the effects of that. So we do see some trajectory and a runway here for this bull market to continue, while there are still many things that are going to get thrown at it. The resiliency of the retail trader and the retail investor remains very, very strong. And that's also keeping the market up high. And that's what kept the market and allowed the recovery to be so quick in April and May, was the retail investor was buying the dips. So if you have questions about how to navigate this market or where we see it moving forward or how AI is going to impact everything, just feel free to reach out to us. We'd love the opportunity to speak to you. You can reach us at 904-346-3460. As always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.